Welcome to Elevate Your Wealth, and today we'll be talking about wealth protection and wealth management. So I'll start off with wealth protection. It's one of the topics not many people like to discuss, but it's important, so we will discuss that, and then we'll talk about wealth management, which is a part of, or rather a topic lots of people love to discuss. So obviously we've covered a few topics before now, wealth creation, and a few other things before now. So in terms of wealth protection and wealth management, what does that give you? Why should you even think about it, what it is in the first place? Wealth protection is protecting what you have and ensuring that you've done all you can to touch wood, hopefully not in an unforeseen situation out of your control. You are still in a suitable situation where your standard of living hasn't dropped or hasn't dropped too much. Wealth management is the same as well. So management is where you are actively doing something to enhance that situation you're in, that standard of living, or just maintain it at least. Okay. And benefits of all those is, look, you're going to have peace of mind. So peace of mind is a very underrated asset. People that have it, thank God you have it. People that don't, let's do things that can get you there, especially from the wealth path. And, get confidence as to, taking on other things in life because, that wealth path is covered. You just have a safety net as well. The concept of a safety net is when you fall, not many people fall intentionally. In fact, I'll be surprised if people do. But when you fall, something can catch you, okay? And you're not in a situation where you're really disadvantaged by that fall. Okay, and the last thing as well is just to avoid any opportunity costs. I really mentioned opportunity cost in the last episode. Not doing anything about your finance has a huge opportunity cost. It's not like Taxman where they come and give me the taxes. No, but it's lost value, and value that is very hard to get back because time just keeps ticking every day. Diving into wealth protection. So wealth protection is really about protecting your human capital to a huge extent, okay? Because until you retire, your human capital is going to provide you lots of wealth. It's going to provide you lots of financial capital that you can then lever. So there are generally about 6 different types of personal protection covers that help you, and I'll drill down into some of them. Some of them will be relevant, others will not. Generally, 2 of them are more relevant for business owners than others. Life insurance, first one. So life insurance is pretty straightforward. Touch wood, hopefully not. You pass away. What do you want to leave for your beneficiaries? Do you have any beneficiaries? Do you have any dependents? Do you have any one that if you're not in the picture again, your standard of living will drop? So life insurance provides a lump sum, okay? And that lump sum is paid to your beneficiaries if you're to pass away. And that just helps them with several things. I'll use our classic example of people within 40 to 59. They might have dependents, they would have a mortgage, they'll probably have a partner. Life insurance ensures the partner doesn't have to sell the house and downsize and, potentially be in a position where they're not living a decent or not having a decent standard of living compared to what you people planned. It also provides for education for the kids. If you want your kids to go to private school, that is expensive. You need to kind of factor that in because, that'll be, 6 years of some expensive payments, usually very hard on just one income. And, you might also want to provide other money to other relatives or, other people that loved ones in your life. So life insurance helps with that. The other one is total and permanent disability. So TPD for short. You hear lots of professionals in this field just saying TPD. So there's a lump sum cover as well. And that is paid out to you when two medical professionals say it's unforeseeable that you'd go back to your previous job or you'll go back or you'd recover from this illness. And that lump sum is just to help with paying off the mortgage, ensuring that someone can actually come take care of you if you are in a situation where you need taking care of. You don't want your spouse to become a full-time carer, and you still want them to live life as well, So that just ensures you have that covered. And with total and permanent disability, the premiums can actually come from your super, which is nice and handy. But with that as well, what is factored into the cover is medical expenses. There generally will be some out-of-pocket medical expenses. And, total and permanent disability, a few examples is think about loss of limbs, loss of sight, loss of hearing, something that you cannot come back from. Few of the claims we've seen these days is more around mental health issues. Okay, so if someone has gone through some traumatic events and they're on, and doctors say they can't really see them coming back from that, that is definitely something that can get a total and permanent disability claim for. And the next one is trauma insurance. So trauma covers you for a traumatic event. So think about cancer, heart attack, stroke. So those are things you can generally come back from. Okay, but they will sideline you from the workforce for about 1 or 2 years. So you want to be able to take care of yourself within that period of time, and not worry about money, not worry about treatment, but just be in a situation where, okay, you're going through treatment, you're focusing on your health, and that wealth has been taken care of. And I'll give you an example later on of someone who we've helped with some of these covers. So with trauma cannot be held through your super. Generally has to be held outside super, and that just gives you a lump sum as well. Generally, a traumatic amount is less than the amount you get from a life or a total or permanent disability, because, as I said, it's something sidelining you for 1 or 2 years. The other one we have is income protection. So I think this is by far one of the most important for anyone working. You're working, you're earning some income. That human capital you have has to be protected, because if you're in your 20s, 30s, even someone 2 years away from retirement, the amount you can lose by not working for 2 years due to injury or illness is a huge amount. So you definitely want to be protected. So generally, income protection covers you for up to 70% of your income, and that is an income stream. What that means is you're paid every month for as long as you cannot work. And that just helps with, your living standards, helps of pay the mortgage, helps you pay rent, helps you put food on your table if you're unable to work. And, in a society where you kind of really need to take care of yourself, you need money coming in, So there are very few people that would actually just give you a salary if you're unable to work. One of the classic objections I get is, I have a rich family, they'll just give me, they'll just take care of me. I'm like, yes, that's perfectly fine. They will take care of you. But isn't that more reason where if you have a rich family and you can afford this, you put one in place? So you're not dependent on the family, and whatever they do is then a plus. So to me, income protection, no brainer for anyone working. You need to protect your human capital, your most valuable asset. People say, time is my most valuable asset. Time is your most valuable resource, okay? So in terms of an asset, it's your ability to work. So do not mistake that, and you should definitely have some income protection in place. Good thing about income protection, when we talk about wealth creation and even the wealth management as well, that can come from your superannuation accounts in terms of premiums. And, there's a balancing act there where for younger people, we want to protect your human capital, because, if you can't work now, nothing goes into your super. And, for people later on in life, closer to retirement, we really want to maximize your retirement. So, but there's a balance in that to ensure you're protected and still hitting your future goals. The other one is buy-sell insurance. So this is very important for business owners. And generally, it just gives you the ability to buy out a deceased or disabled partner. Okay, so if you're in a business with other business partners, generally you might own the business 50-50. And if something was to happen to a partner and they're disabled or they're deceased, you want the ability to buy out that partner, because the partner's spouse or beneficiary may not be able to deliver the same value, knowledge, expertise that this partner was delivering. So you don't want to be in a situation where you have to buy them out, but you don't have the money to do that. So very important for business owners. Another one important for business owners is called key person insurance, key person protection. And generally, that's just to protect a key person in the business. Okay, and that key person if they were to leave the business and be unable to work, all of a sudden that business suffers a lot. So there's protection around that to ensure if they were to be deceased or disabled, the business can still cover some or majority of his ongoing costs as well. So those are the types of different protections which we put in place for individuals and then for business owners as well. And yeah, I always say protection is what I hope you never have to claim on. At the same time, if you are in a situation that you needed to claim, is something you definitely want to have. And no one knows the future, so we can't really say, okay, well, you need it, you don't need it, based on the future. So you definitely want to be in a position where you have that covered. I'll give you an example of Mr. Thompson. So it really sets in, and then you understand how protection works. So Mr. Thompson is a successful business owner, has been running the business. Life has been good, and he was unfortunately diagnosed with cancer. So he was going through, he then started treatment, and that sidelined him from business. So he couldn't work, he couldn't earn money. But luckily for Mr. Thompson, he had trauma cover. So that trauma, because he was diagnosed with cancer and it met the conditions on the policy, he was paid out. And that payout ensured that, he can fund any extra medical treatment. He didn't need to worry about the small mortgage he had on his principal place of residence. And, that took care of that. Generally as well, when you are unable to work, you can get a trauma payout and an income protection. So he got income protection as well, which just helped with the daily expenses that come up for him. So, from that personal side, he was covered, so he was getting money. The family didn't need to worry. Now, the business was suffering, but because he was able to put some key man insurance in place and business continuity cover, he also got payout in the business to ensure that the ongoing costs of the business are taken care of. And that way, the business doesn't need to suffer. Because generally what happens with business owners that go through a temporary time of illness or, sidelined from the business, they want to come back to the business after 1 or 2 years. They don't just want the business to suffer. So having cover in the business ensures that you can come back to the business and pick things up from where it last stopped. In that as well, there's something called business continuity cover under the key person, and that just covers ongoing expenses in the business as well. So he had that, which was good. So he was fully covered. Everything was going well. After 2 years after 2 years of going through treatment and struggle, he came back and he picked things out. He picked things right back from where he started, which ended up being good. Unfortunately for Mr. Thompson, he then passed after about a year. And what happened after that is he then got life insurance cover. Okay, so the life insurance cover was paid to his family, and that also ensured that they didn't need to worry about the mortgage. They didn't need to worry about any other future expenses, and that was paid to his beneficiaries. On the business side, Mr. Thompson had a business partner, and the business partner was able to buy out the family, and then that way the business partner fully owned the business. But at the same time, the family did get a payout, which was good for them. So unfortunately, Mr. Thompson passed, but everything else was taken care of. So that's just a fictitious example of how insurance can help clients. Okay, and I've seen this in different pockets every time. People maybe just claiming on trauma and income protection, just claiming on business expense, or just claiming on key person insurance. So these are things we help people with as well. So it does happen, and we just don't know who it will happen to. So it's essential to have cover in place. So now, when we talk about wealth management, or moving on to wealth management, I think wealth protection is a key area that has to be addressed. But wealth management is another key area as well. And when you think about wealth management, I want you to think about, continuous exploration as to, okay, how better can you manage your wealth? And at the same time, I also want to think about, okay, how do you protect the assets you have now? Okay, so this is not your personal protection, but more about the investment you have, how can you actually protect that? And another one as well is asset allocation. How do you put your assets? And we'll drill down into asset allocation in a bit. So for wealth management, generally, when I talked about wealth creation, I talked about different types of assets you can have. And, these assets, you need to locate them somewhere. These assets need to be held in a certain investment and by a certain entity. And generally, there are about 9 different ways you can locate these assets. It can be located in your super, in a family trust, unit trust, investment growth bonds, operating company, holding company, individual name, joint name, spouse name. You get the point. There are a few ways you can structure this, and all this comes down to the goal around the investment, and obviously, what is the most tax efficient way to do that. If my math skills are still good, permutation, combination. If you look at that, there are certain ways you can actually combine all these entities I just spoke about. So there are probably about 61 ways you can combine these entities and then hold a certain asset, because they can be joint, they can be held in a certain name or in a certain platform. That is location of assets. So that is quite important for wealth management, because as you transition from accumulation phase to deaccumulation phase, there will be different movements in the location of assets. A classic example is you might be holding an investment growth bond in your spouse's name because you want to save for your kids. I know that has been that way for the last 10 years. And maybe after then, you as a family decide to set up a family trust. You can then move that investment growth bond from your spouse's name to the family trust. That is a movement, or that is wealth management in moving things around for a better outcome. Fast forward even 10 years after that, you might have wanted to give that to John, but John has been a naughty boy, so you're not going to give that to him again. You can actually change that ownership from the family trust into another entity as well. So those are, asset location, and that plays a huge part with wealth management. And it's not a one size fits all, and it's not I'll do it now and I've set it up for the next 10, 20 years. Generally, there will be some movements in those. So that's asset location. Now there's asset allocation. So asset allocation is how do you spread your assets, okay? And where should they be located for optimal use or optimal transfer, or just getting to your goal, okay? So when you think about that, you need to align that to your risk profile as well, because sometimes some higher growth investments versus defensive investments should be located in other places versus just putting everything into the one, and that's really crucial when it comes to tax planning and having taxable investment. So asset allocation is very important. Just a quick highlight on that. Okay, where should you put your investment? Where should you put your international stocks? Where should you put your domestic stocks? Where should you put your bonds? Where should you put your cash? How should you spread it across those different locations that I spoke about? So that's something we help with. Regular reviews and rebalancing, so this also comes down to how generally your risk profile changes over time. I might start with a client who is in the early 20s. The risk profile is, an 8 out of 10. 2-3 years down the track, they fully understand that, they go to a 10 out of 10. And then, in 10 years' time, they'll actually want to start reducing risk because now they have dependents and they really want to not take too much risk. They might go to a 7. So that rebalancing and movement actually takes part from time to time. And you can rebalance the constituents, okay? And when I say constituents, I mean the assets within each asset allocation, okay? Or you can rebalance the asset allocation, okay, as to, okay, how much do you have in international, or how much do you have in stocks in general? And, should we be moving some of those into more defensive assets at a certain point in time? And in terms of tax efficiency as well, this has been an interesting concept for me as I learn more about it. And, my previous studies in the CFA really helped me understand this a lot more. So, tax deferral is a very underestimated benefit, okay? And that is just the ability to pay tax at a future date. So if you can move that or put your assets in certain locations that allow you pay those taxes in a future date, you actually create more wealth because the taxes are not paid, they stay there, they grow more, and you actually benefit more because you're indirectly benefiting from whatever you should have paid in taxes straight away. So there's a good chance there that if you defer as much taxes, obviously legally, please not illegally, as much as you can, you are in a good situation for actually building wealth. There is tax exempt accounts as well. And, a classic example of that is your super. Generally, once you retire and you hit a condition of release, within certain limits, whatever you have in your super, you don't pay any taxes on, so that's a huge advantage for when you get to that stage. You need to balance that as well. When I say balance that, individual or someone in your 20s, 30s, and really thinking about how you can put all your money towards your 60s, where you then get that tax exemption, might not be the optimum strategy because things will come up when in your 40s, things will come up in your 50s that you need to handle or you need to deal with before going there. So wealth management is a balancing act, and it really depends on your goals, objectives, and at what stage in life you are. So one of the things about investing as well and wealth management is actually when you sell your assets and when you liquidate them for optimal use. A classic example is if you're going to have a capital gains, you probably, all things equal, you probably want to be selling just after the financial year. Because what that means is you don't need to pay those taxes until the following financial year. So all of a sudden you have some money you can play around with until that point in time. And it might just be simple things like putting it into an offset account, and that reduces, the interest you need to pay on that. And, when the taxman comes knocking later on, you'll be like, yep, I sold that July last year, and now I'm going to give you what I owe you. So in terms of strategic investment selling, those are things to really consider as well. If you're going to have a capital loss, you might want to sell that just at the end of the financial year so you can claim that straight away against any capital gains you might have had before now. And what accounts do you want to put that in? What accounts should you sell that in? Like all those are things that not maybe sit down and think about, but all these actually things that can help you manage and even grow more wealth. When it comes to wealth management as well, you really need to pay attention to estate planning, okay? Because, location of those assets and, the future beneficiary of that is very important. People always want to buy property for the kids. And, one of the questions I ask is, do you know if the kid will want the property? Do you know if you're going to sell it straight after? Is it better to actually give them an investment where they have more flexibility? And, yes, you might still get the property for some of the tax benefits it gives you as an individual, but then it's not linked to this is the gift for the kid, because there are other ways to actually structure that. So asset planning comes into play once you're really looking at, okay, wealth management, who's that going to be for? How long do I need to give it to them? Do I want to maintain control over that? All those are actually key areas to look at as well. And I think in terms of things like setting up a will, setting up a trust, you need to ultimately do that with advice, not just do it blindly. Mr. Joe across the road might have done it. Doesn't mean you yourself need that. There might be several aspects in Mr. Joe's life that you don't know about, and makes it more beneficial for him to set up one versus you yourself. When it comes to estate planning as well, people underestimate things like a power of attorney. Okay, so someone that can make decisions on your behalf if you cannot. You might not just be in the country, or you might be unable physically due to illness to make decisions. Who is going to make that decision for you? That is very important. When I sit down with couples, I'm like, look, this is important because I know both of you, especially if I work with them for a while, I know what you're probably going to say and how you're probably going to address a certain situation. But if one of you comes and says, well, do this for my partner and I need both signatures, I cannot do that. So things like power of attorneys are just very important. As soon as you are of legal age, you should have a power of attorney. Designate someone who you trust that can make some financial decisions for you. And retirement planning. So, wealth management and retirement planning, I think that really goes hand in hand, because retirement planning is the time where lots of people actually sit down and then plan, or rather try to manage their wealth. It's like, well, I should have been doing that a lot earlier on because you'd have probably had a lot more. But either way, now that you're doing that, that period in time is where lots of the wealth management comes into play, depending on how complex your situation is. But, having a plan and, sticking to that plan ensures your wealth management is successful, pretty much. So because at that point in time, you have access to tax-exempt accounts, okay? And if you're a couple as well, how do you manage that if one person has a bigger balance than the other? How do you manage that if both of you are above the transfer balance cap already? How do you manage that if you want to give some early inheritance or some late inheritance? Those are the kind of things you need to decide, discuss, and have a robust plan around. So I'll give you an example about wealth management, and there's so many examples I can think about, so many situations, and it just comes down to your personal situation. But this example is around Sarah Jones, fictitious client as well. So Sarah Jones inherited about $2 million from her dad, who recently passed, and that $2 million was just in a company. He was an exec in that company, so he kept that. And now he's passed that on to her. So now, huge capital gains involved in that. And Sarah Jones is like, oh, I don't know what to do. I have all this money. I want to get the best advice. And Sarah Jones then decides to sit down with a professional. And we then decide, okay, well, this is a concentrated asset. This is just in one company. If anything happens to that company, we want to ensure that you still have some money. So we need to reduce the risk, but we don't want to actually sell the shares because it can trigger lots of capital gains. So what we can do is we can actually get a margin loan on part of that and manage that over a certain time frame, because generally when you invest in money, it's not a good idea to just put a huge chunk in straight away. You want to dollar cost average that. Several reasons for that, but one of it is just managing the time we are in the market. Generally, if you're sure at the bottom, which many people, which is hard to be sure of, then okay, you can chuck in everything straight away because you're gonna have a huge benefits down the track. But if you're not, we want to dollar cost average that. So with Sarah Jones, what we did is we put in a certain amount every year, diversifying away from the concentrated position and slowly increasing into a more diversified account. And what that does, or what happens in that situation is, over time, she's fully diversified away from the company, and that gives her more wealth, because if anything was to happen to that company, all her assets are not in that company as well. And, one of the things as well we did, we would do for Sarah Jones, because it's a fictitious client, is ensure that now this new portfolio we're building is actually in a location that is easy for her to transfer wealth to the future beneficiaries, if she has any beneficiaries, or distributes to other members in her extended family or friends. Regular reviews of that. And one thing we know, and one thing I always tell clients, is I think things will change. So let's not get a plan and be fully bogged down with that plan if we have to deviate, because if things change, we just pivot away and then we move into the next best direction based on the new situation as well. So as we know with Sarah Jones, things would change. She might want to then pass some wealth to someone. She might find a partner. She might have dependents. We don't know what that is, but we need to be able to make some room for such decisions to happen. As a result of doing all this and helping Sarah Jones, she was now confident as to her wealth building and her wealth management, just knowing that there's a professional that can actually help her with all these concepts we've spoken about. And that gives her time to focus on other aspects in life, So that is a classic example of how we can help someone wealth manage and plan for the future. I like summing up with an analogy, and today we're going to be talking about a house. So think about your wealth protection as the foundation of building a strong house. You know, if you've covered for disability, illness, all of a sudden you have a strong foundation that if anything unexpected happens to the house, that foundation still remains strong. Think of your wealth management as the ongoing maintenance and improvements to the house itself, you know. So it might be, okay, you might knock down a wall, you might redecorate a room. So that has to be constantly done every time to ensure your house is where it should be or where you want to live and provides you the value you want. So when you look at having both wealth management and wealth protection, it's an ongoing process where you need to ensure that everything is working efficiently and as best as it can for you. Because if you ignore certain cracks or certain improvements in the house can fall down. If the foundation wasn't great in the first place, nothing else can be guaranteed if unexpected events happen. So you want to build a strong foundation. You want to ensure improvements to the house are ongoing and you regularly pay attention to that. And then that way you're going to have a nice, lovely house to live in. So do not ignore the foundation and do not ignore any cracks in the wall.